Hello everyone, this is James Feng. Um, Today we're going to talk about the consolidation of financial statements. This is going to be under IFRS. So we're going to first talk about the related IFRS, and then I'll show you an example of annual report, which is London Stock Exchange Group. They have very beautiful annual report, very standardized. So we're gonna take a look at that. Then we are gonna talk about the type of consolidations. Some of the associates and subsidiaries are not required to be fully consolidated. So we have to identify those entities first before we can working on our consolidation. Actually the consolidation is pretty easy. Let me show you in 5 steps to finish that. Then of course there are some complex scenarios like the ownership changed, and we're also going to mention that. So first, related IFRS. So IAS 27, separate financial statement, and IAS 1, representation of financial statement, IAS 7, statement of cash flows. These are all related to standardization of financial statement. And IFRS 10 is consolidated financial statement. IFRS 3, IFRS 11, IFRS 12 is all about a group, company, and consolidations. So you may would like to go through all those standards before you can working on the financial reports. Okay, so we're gonna start with an annual report, which is the London Stock Exchange. So they have very standardized financial statement. As you can see, we got strategic report, governance, and group financial statements. This is what we are going to talk about today, and shareholder information. Okay, but although the group financial statements are all here, but actually a lot of items going to refer to the financial statements in each of those informations. Okay, so this is very important, and so we're gonna first this is the opinions and informations provided by auditors, and they got 9 pages, which includes a lot of those informations like audit opinions, basis for opinion, and a lot of conclusions, overview approaches, key audit matters, a lot of stuff. But this is traditionally for private companies, audit report is pretty much shorter than that. But 9 pages, it's worth to look at that. If you are working on audit or you are gonna have an audit examination, you're gonna look into that, especially on how auditors identified all those risks, and the response and how the management responds that, and also how they communicated to audit committee. Okay, next is the consolidated income statement. So this is really very typical, from revenue to profit before tax, then tax, okay, and profits belongs to parent and NCI. Okay, and then they got EPS and DPS. Okay, and also dividend. So here they got they have underlying profit and non-underlying profit. So this is separated by those activities that's regularly happening. The internal management would believe this is more relevant. But now underlying is like it's a one-time or it's infrequent infrequently happened. Next one is consolidated statement of comprehensive income. So here we got this is profit plus OCIs. So here items that will not be subsequently reclassified to PL. So that means this gonna be stay in OCI forever. But next one is items that may be subsequently reclassed to PL. That means under some cases, those OCI should be will be reclassed to PL. So this is possibility. It depends on the future event and future activity. Okay. This is the comprehensive income, and then we got balance sheet. This is very typical with a comparing period, signed by CEO and CFO. Okay, and then we got the cash flow statement. Of course, they also have small notes saying that what is the non-underlying items related to cash flow. Okay, then we got the statement of changes in equity, and some notes on certain numbers of the changes in equity. So as you can see, here we got the equity changes for parent, and here this one is for NCI, and then we got total equity. So this is the subtotal and then total. Okay. And last, there's many pages of notes. Okay, so I'm just showing part of it, including the basis of how you prepare the financial statement and what kind of accounting principles you adopt, and especially they have mentioned here there's a new accounting standard, the LEAS IFRS 16, active from the beginning of 2019, and then the financial risk management. They have mentioned many risks, including capital, credit, and concentrations, country liquidity, credit, FX, interest, a lot of the risks, and also significant charges and estimates. So those are the background and the basis of the how you prepare the financial statement. And then they detailed into segment information by segment. There are the specific IFRS defines how a company should report the segment information, and expense by natures, non-underlying items, and all different couple of accounting items. Okay, so this is the very standardized annual report. You should have an idea on what kind of financial reports looks like. Okay, this is the London Stock Exchange Group. This should be very you can rely on it. Okay, so you would have an idea what it looks like. And then types of consolidation. Okay, so here we got subsidiaries more than 50%. So we're gonna fully consolidate this. This is what we are going to talk about during the details of consolidation. And then associate is between 20% to 50% shareholding and voting rights. Okay, so we call this kind of holding significant influence, and we use equity method. That means we're not gonna consolidate that. Okay, the dividend and the movement of the profit gonna be reflected in our investment that account, but we're not going to take everything to consolidate. Okay, and this is JV. JV, it depends if you have an although you have for example 60% shareholding, but all the shareholders haven't had an agreement saying that for every decision you have to have 90% agrees. So that means 60% means nothing. You cannot decide anything even you have the majority shares. So this is a JV. We are also going to use equity method. And then JO. JO is like all the shareholders have direct rights to the asset and liability. It's not then the associate is not like the sub is not like an independent entity. It's like it's just a share, or it's a shareholder can penetrate to directly to the asset and liabilities. Okay, and then 5 steps to consolidate. Okay. I made this very easy because normally when you understand the 5 steps, and then it's not easy for you to handle all the rest different cases, like if you can handle the PPE and the inventories, it's not a different for internal loans or internal interest payable and receivables. It's similar. Okay, so step 1, we're gonna do the goodwill. Okay, and so for the goodwill, we're gonna look back to the historical data, the day the acquisition happened. So we debt, share capitals, retained earnings, and OCIs of the subsidiary, and then we if there's any revaluation of non-current asset, we're also gonna reflect the incremental of that asset. Okay, and then we got investment in subs. This is how much. This is the money you pay for the acquisition. And then you got DTL. DTL is generated by the revaluation of the non-current asset. So you're gonna find the incremental amount of the revaluation, and then you multiply that with the tax rate. Then we got NCI. NCI is calculated by the equity plus the PPE incremental and less the DTL, and multiplied by the shares of NCI. Then you got, congratulations, you got goodwill. Okay. So this is how we calculate goodwill. Should be pretty easy, and this is one time you do this every year. Okay. And step 2, the fair value adjustment at acquisition date. So this is the revaluation of non-current asset we mentioned. And so each year, if that is PPE or intangible asset, you're gonna amortize it or depreciate that. So each year you have depreciation from consolidation perspective view. You're gonna depreciate that, right? So before the end of before the beginning of this year, you have this is the depreciation prior this year, okay, and then this is the tax effect relates to the depreciation. And this year we have one more year depreciation and then the tax effect. Okay, so this is pretty much straightforward about the historical revaluation increase of your asset. Okay, and then we're gonna eliminate internal transactions. Let's take an abstract example here. If your sale, if subsidiary sold the PPE to the parent, then you have to you have internal gain or internal profit. You have to reverse that internal profit, and this is the related tax effect. But that that is a PPE you are selling, so that the PPE is depreciating every year. So you have to consider the depreciation, which is an offset of the internal profit. So this is the prior year entry. So if this transaction happened this year, this is similar. It's just we're not debit returned earnings and NCI. We just debit the P&L. Okay, and for inventory, this is also easier. For if there is any internal profit, you're gonna reverse it and consider the tax effect. If it happened this year, you're gonna reverse it to PL and then you consider the tax effect. Okay, and this is step 3, and don't forget the internal receivable and payable. That should be very easy, so we didn't mention it here. And step 4, okay, this is impairment of goodwill. So we're not going to talk about impairment of goodwill this time, because you need to allocate goodwill to CGUs, and then you're going to compare it with your book book value. So here, let's just check the result. We have previous impairment, goodwill impairment for previous years, and this year. So you're gonna effect to RE or P&L separately. And for dividend payment, if there's any dividend payment from subsidiary to parent, you're gonna do this entry. This entry means that there are some benefit paid from the whole company to NCI. And then last step, we allocate profit to NCI. So we have profit and OCI for this year. All those amounts are in the profit and loss statement before adjustment. And then we have all those adjustment, right? And we adjust everything to P&L for the current year. So we're gonna have to separate the profit by parent and NCI. So this is what we do. We cut the share of NCI from this year's profit and OCI. So as you can see, this is pretty much straightforward. Goodwill, fair value adjustment, eliminate the internal transactions and the impairment, goodwill, and allocate to NCI. Okay, so and then it's congratulations, you can upload everything to your template. Okay, so we have those entries, and you're gonna make sure all your calculations and you upload to the right place, and all your links are perfect. Okay, so this is the 5 steps for consolidation. Okay, and again, there are some difficult scenarios in the consolidation. For example, with ownership change. Let's see. In case we partially dispose our shares, that makes our lost the control. Okay, then in a separate financial statement, we're gonna recognize again. And from the consolidated financial statement perspective view, we are basically canceled the gain and canceled the investment in sub at cost at financial at a separate financial statement level, and we recalculate everything again. Okay, and then we got increased control. We have control originally, and then we buy more shares. So this is the separate financial statement and consolidation. And another case is that we partially dispose our shares. However, we still have the control. Okay, so that's in that way, if there's any gain or loss, we're gonna put it into OCI. Okay? So we have to be very careful on the accounting treatment from separate financial statement and as well as the consolidated financial statement. Okay, I think this is today, and thank you everyone for listening. If you are interested at more accounting or finance or tax topics, let me know. And yeah, you can talk to me through my WeChat or Facebook, and anytime. Yeah, thank you very much.